Hey there, fellow wealth enthusiasts! Are you ready to dive into the intriguing world of finance and discover the secrets of the wealthy? Well, you're in for a treat because today we're going to explore a fascinating topic: 5 ways rich people make money with debt. That's right, folks. Contrary to popular belief, not all debt is bad. In fact, there's good debt and bad debt, and rich individuals know exactly how to leverage it to their advantage. But before we jump into the nitty-gritty details, I want to make sure you don't miss out on any valuable insights. So do me a favor and hit that subscribe button right away. By subscribing, you'll be joining our ever-growing community of financially savvy individuals eager to learn and unlock the secrets of wealth creation. All right, let's get started. Number 5, using debt for living expenses. Our first strategy takes a unique approach to managing finances and minimizing taxable events. Wealthy individuals often use debt to cover their living expenses, thereby avoiding income tax and the need to sell assets for capital gains. Here's how it works. Let's say an investor has a portfolio of stocks and wants to cover their living expenses. Rather than selling their stocks and incurring capital gains tax, they can utilize a margin loan offered by their broker. This way, they can access funds without selling any stocks at the moment. Later, when the time is right, they can pay back the loan by selling stocks that have incurred losses, resulting in no capital gains tax. Moreover, high net worth individuals can live off lines of credit backed by their assets. By carefully choosing their sources of repayment, they can take advantage of optimal taxing structures. For instance, they may consider selling a personal residence, which is non-taxable in most states, or divesting losing investments. Additionally, they can take advantage of lower tax rates on dividends and capital gains from stocks, providing a more favorable income compared to high-income tax brackets. Number 4, margin account. Let's move on to another financial tool that wealthy individuals often employ: the margin account. A margin account is a type of brokerage account where investors can borrow cash or shares from their broker using their existing holdings as collateral. This borrowing power adds fuel to their trading activities, increasing the size and frequency of their trades. Margin accounts provide investors and traders with the ability to amplify their results. By trading with larger positions, their wins can be twice as substantial, but the same applies to their losses. Day traders in particular benefit from margin accounts as they can maintain buying power without waiting for all their trades to clear. However, it's crucial to approach margin trading with caution as it involves added risk. While it can accelerate your profits, it can also magnify your losses if the market moves against your position. So always tread carefully and make informed decisions when utilizing margin accounts. Number 3, short selling. Now, let's explore a strategy that's often associated with the world of stocks and investments: short selling. This clever technique allows investors to profit from a decline in the price of stock. Here's how it works. Instead of following the traditional order of buying low and selling high, short selling flips the script. When you engage in short selling, you borrow stocks from your broker and sell them to a buyer, even though you don't own the shares initially. This transaction leaves you in debt to your broker, as you owe them the shares you borrowed. Later, when the stock price drops, you repurchase the shares at a lower price and return them to the broker. If you buy back the shares at a price lower than what you sold them for, congratulations, you've just made a profit using debt. Short sellers can capitalize on both upward and downward movements in the stock market, allowing them to profit regardless of the market's direction. However, it's essential to keep in mind that short positions come with certain costs, such as margin interest and dividends to be paid during the short period. Number 2, leveraged buyout. Get ready to dive into the captivating world of leveraged buyouts, LBOs, a powerful financial maneuver employed by savvy investors to acquire companies and unlock their wealth potential. Let's explore this strategy in greater detail. So, what exactly is a leveraged buyout? Well, it's a technique where a buyer or group of buyers takes on a substantial amount of debt to acquire a company. The assets of the targeted company serve as collateral, providing security for the lenders and allowing the buyers to gain control and ownership of the business. The true magic of a leveraged buyout lies in what happens after the acquisition. Once the buyer has taken control, they utilize the future cash flow generated by the acquired company to gradually pay off the debt. This process not only reduces the debt burden over time, but also increases the buyer's equity stake in the company. Think of it as a strategic chess game. The buyer carefully plans their moves, considering the company's potential for growth and profitability. By acquiring the company and strategically managing its operations, the buyer aims to increase its value, generating substantial returns in the process. However, executing a successful leveraged buyout requires meticulous planning through thorough due diligence and a deep understanding of the target company's industry and market dynamics. It's not a venture for the faint-hearted, as it involves taking on significant financial risks. But when done right, the rewards can be truly extraordinary. Leveraged buyouts have been employed in various industries, including manufacturing, technology, and finance. Some notable examples include the leveraged buyout of RJR Nabisco in the 1980s and the acquisition of Dell Incorporated by its founder, Michael Dell, in 2013. Number 1. Leverage in real estate. Our final step on this journey takes us into the lucrative world of real estate. Rich people have mastered the art of leveraging their capital to multiply their investments exponentially. Imagine this. With just a 5% down payment, real estate investors can own properties worth 20 times their initial investment, or even more. Let's break it down with an example. Suppose an investor puts down $10,000 on a $200,000 house with a monthly payment of $2,000. Now here's the fascinating part. If that property appreciates in value by 20% to $240,000, the investor's $10,000 down payment has effectively generated a staggering 300% return on investment. Astounding, isn't it? But that's not all. Debt can also be used to acquire monthly rental properties or houses for short-term rentals like Airbnb. By utilizing leverage, investors can create cash flow assets that generate consistent monthly income. And here's the beauty of it. The returns are based on the total debt, not just the initial investment. Talk about maximizing your profits. And there you have it, folks. 5 powerful ways in which rich people leverage debt to build their wealth. From real estate investments and leveraged buyouts to short selling, margin accounts, and utilizing debt for living expenses, these strategies exemplify the financial acumen of the wealthy. But remember, every financial decision carries inherent risks. It's crucial to conduct thorough research, seek professional advice, and fully understand the implications before implementing any of these strategies in your own life. Knowledge is power, and by arming yourself with the right information, you too can make smart financial choices. So what are you waiting for? If you haven't done so already, make sure to hit that subscribe button and join our community of wealth enthusiasts. We've got plenty more insights and tips to share on our channel, empowering you to take control of your financial future. Until next time, stay curious, stay informed, and keep striving for financial success.